This isn't just a credit crisis, it marks the onset of an economic downturn that is poised to significantly transform our lives. The credit squeeze is on the verge of causing a substantial surge in bankruptcies across the United States. According to warnings from Goldman Sachs and other major Wall Street institutions, millions of Americans are at risk of losing their jobs due to the impact of the Federal Reserve's policies. Currently, the largest American banks are deeply concerned about the increasing instances of loan delinquencies and defaults. Consequently, they are reducing the money lent to businesses and consumers at notably higher interest rates. There's a high probability that both companies and individuals will struggle to keep up with their loan payments, leading to elevated risks of substantial financial losses for banks. Before we go any further, make sure to subscribe to the channel and leave a like below this video. These major financial institutions are noticing concerning trends that signal trouble for the U.S. economy. Their clients are withdrawing larger sums from their accounts every month and are also saving less, indicating that many individuals may soon resort to taking on more debt as their savings dwindle. Similarly, U.S. businesses that acquired loans during a period of low inflation and interest rates are now experiencing cash flow problems and difficulties in repaying their debt due to the current higher rate environment. With consumers reducing their spending, many companies are witnessing declining sales while their operational costs, including labor and leases, remain at peak levels. The Federal Reserve's interest rate hikes have significantly increased borrowing costs since the first half of 2022, amplifying banks' exposure to bad loans. As a result, these banks are limiting access to credit lines in response to the growing threat of potential bank failures. The outlook for U.S. banks hasn't appeared this challenging since the Great Financial Crisis of 2008. Tightening lending standards is the method these firms are adopting to conserve funds and brace for worst-case scenarios. These savings will serve as a buffer when the real crisis unfolds. They are allocating more funds each quarter in anticipation of an imminent economic or financial market breakdown, indicating that something substantial is on the horizon. Their rationale is straightforward. They're attempting to safeguard their stability following the industry-shaking meltdown in April, particularly as various indicators forecast increased turmoil in the coming months. By slashing credit lines, these banks aim to stem the financial hemorrhage before it exacerbates. However, this action also sets the stage for an unprecedented increase in business bankruptcies, cutting off a critical lifeline for struggling companies. Since the pandemic hit, Main Street has continued to face challenging conditions that have not substantially improved. As rising interest rates draw more liquidity from the system, more small businesses, especially those already on extended life support, termed zombie companies, are likely to encounter profitability and cash flow issues. This predicament could potentially jeopardize hundreds of thousands of businesses, adding to the bankruptcies that have already occurred this year. Data from S&P Global reveals a sharp increase in corporate bankruptcies in 2023. Economist Peter Sanan attributes this problem to a simple factor: banks are not lending. The credit conditions for small companies are at levels consistent with a recession, and the number of mid and small businesses filing for bankruptcy over the past 9 months has exceeded previous highs. Tight credit conditions usually precede or accompany reduced profits for smaller companies, resulting in declines in employment growth. Instead of addressing the mounting problem of businesses closing down, the U.S. government is imposing new capital rules for large and regional banks, further restricting businesses' access to credit. The initiative known as Basel III Endgame, B3E, forces banks to increase their reserves by 16% whenever they issue loans to companies without exceptional or excellent credit ratings. This move, aimed at making lending more restrictive, is exacerbating the cash problems faced by small businesses. Ultimately, as more account holders withdraw their money from the system, these regulatory changes compound the challenges faced by small and mid-sized companies. The measures set forth in Basel III inadvertently hinder small businesses, worsening their financial woes. Bank of America, meanwhile, worries about the impact of these policies on U.S. consumers. In March, analysts from Bank of America warned that the Fed's actions to curb inflation might push consumers to their limit. Bank of America's CEO, Brian Moynihan, in an interview with CNBC, pointed out a significant shift in consumer behavior. The amount consumers spend has shown a marked decline from 10% growth in spending from 2021 to 2022, dropping to 4.5% in the third quarter of 2023. This decline suggests that consumers are either hesitant to spend or have reduced savings to maintain their spending levels. Moynihan emphasized that the interest rate environment and associated factors are slowing down consumer activity. Echoing these concerns, J.P. Morgan's executives supported the observation made by Citigroup CEO Jane Fraser, stating that signs of strain are emerging in consumer spending. A new Associated Press poll affirmed these worries, revealing that many Americans are finding their household expenses outpacing their incomes, leading them to save less for the future. The poll revealed that nearly 2 in 3 Americans reported an increase in household expenses over the past year, while only 1 in 4 experienced a rise in income during the same period. Many respondents expressed that their household debt had increased, with a significant portion carrying credit card, auto loan, or medical debts. However, only a small fraction reported an increase in household savings. Individual stories in the poll reflected this financial strain. One respondent, 61-year-old Steve Shapiro, shared that his grocery expenses had doubled despite stagnant income. He expressed his financial concerns and the challenge of meeting his retirement goals. Tracy Gonzalez, a 36-year-old construction worker, faced significant medical debt due to a surprise tooth infection and found herself avoiding medical treatment because of the costs. Moreover, the poll indicated that over 3 in 10 Americans had to forgo major purchases or medical procedures due to higher interest rates in the last year. This situation raises concerns about how millions of Americans facing similar issues will cope if the credit crisis continues to impact businesses and jobs, ultimately affecting their ability to afford basic necessities. The situation appears dire, with far-reaching implications across society. The prevailing concern is how individuals will manage without a job and access to credit. This crisis has the potential to impact various facets of our society, and the pain experienced thus far might only be the tip of the iceberg. The consequences are dire and solutions are crucial. Your thoughts on this matter are greatly appreciated. Thank you so much for watching. Please make sure to subscribe and leave us a like below this video, and let us know your thoughts down in the comments.